Good morning. So yesterday we had a fairly big sell-off, and it was the biggest impact we saw in two sectors. Energy sold off substantially, and a big part of the energy sell-off is that Israel announced that their retaliation to Iran, they would not target their oil production, their oil fields. And that news caused oil prices to really drop substantially. We went from $75 per barrel oil prices down to 70. That's a big drop. That then caused a big drop in stock prices for oil companies. So we saw the biggest drop yesterday in the energy sector. The second big drop was in semiconductor, and that was led by ASML, which it's unusual, but maybe a good idea. We'll see how the market treats ASML today. But ASML announces today, but yesterday they guided a day in advance that, hey, their bookings have really dropped by 50%. And that big drop really caused a lot of concern that what's going on with the semiconductor demand. We're supposed to be in a really big build out for AI, and demand for semiconductors is expected to be quite high, especially for semiconductors that need the best machinery in the production lines, in the foundries from ASML. So the news was a surprise, and it really sent semiconductor stocks down. Notably, Nvidia was down close to 5%, a little under 5%. Broadcom, among others. The semiconductor space really got hit. What'll be interesting to see how the semiconductor space responds today, if it goes up, if it stabilizes, if it goes down. The ASML announcement within semiconductor is big news, but it's only one data point. The next data point that's going to be really interesting comes tomorrow from TSM. And TSM is a foundry. The foundry is like the factory where they make semiconductors. The biggest one, or the biggest company in the world for semiconductor foundry fabrication, is TSM. So they're set to announce tomorrow, and they're going to tell us how they're doing, and we'll see how their growth rates are. They had seen a pretty significant drop from their high of a couple years ago, and are rebuilding their revenues. Now, is that rebuild continuing to accelerate because of AI, or are they also seeing somewhat of a lowering of demand? That's going to be really interesting. And then the last note I'll put on the semiconductor space is more information's coming related to semiconductor on Tuesday when Microsoft announces. Microsoft is the second largest infrastructure cloud provider, also known as hyperscalers. And if they announce that, their CapEx is really going down, that they're not really expecting to build out at these accelerated rates, that's also going to be news that, hey, the semiconductor space may be too expensive. The projections were probably too high, too optimistic. So I think those three pieces of information will set the table for semiconductor. And of course, we'll hear from AWS, or I should say Amazon, which owns AWS. We'll hear from Alphabet, Google, and what they say is also going to impact semiconductor, as well as Meta, which is a big consumer of semiconductors. So it's really gotten incredibly interesting in semiconductor. It was already incredibly interesting. Semiconductor has been the hot industry for the last 2 years. So it just continues to get a lot of attention, and we'll see how this plays out. It certainly is incredibly interesting to me. Good morning, Shadow Guy. Looks like you are in a train station in the German border within Switzerland. Well, good luck catching your train. I do have a story of missing a train in Italy, and it wasn't too bad. It was an experience. Um, and thanks to everyone else who's joined. I really appreciate it. Thanks for joining. And let me get into a couple of points that I wanted to make and then get into some stocks that I want to look at, principally around companies that are announcing. Before I jump into stocks, I just wanted to note that Bitcoin has really been uh, at a high price. We've seen Bitcoins as low as like in the 50s, 58,000, I believe, in the last 30 days. Now we're at $67,816 per coin. That's a very good price on Bitcoin. And the stock of Bitcoin, the price of Bitcoin has been between 60 and 70 for quite a while. It really entered this space in the February timeframe, and it's kind of been going sideways since then. So we're going on 8 months of the price of Bitcoin really staying at around, between 60 and $70 per coin. It'd be interesting to see if it breaks out and really tries to get to that $100,000 per coin mark, which a lot of people have expected. We'll see if it does it. So that was interesting. That has been something that I look at. I do own and hodl coins. I don't do a lot with them. I don't own a ton. It's a small part of my portfolio, but the returns have just been excellent. I started buying in 2018 and have been trying to learn as much as I can in the space. It's been very erratic at times, but you cannot argue with the return. It's been a very, very good performing asset for me. So I'll continue to hodl my coins and buy more over time. All right. So the stock market is open. How is it going, stock market? What are you going to do today? Yesterday, the market opened, I think, somewhat flat, and then it really sold off. I think the energy and semiconductor sell-off took a little bit of energy and really took off. Got a little bit of momentum going and then took off. So looks like the Dow is flat, but to the green. S&P is flat to the red. Nasdaq's down a little bit. So we'll see how things sort themselves out. So we continue on earnings. And this morning, we have more information from ASML. They pre-guided yesterday. So we kind of got the big news, the big bad news. But we also got earnings from Abbott Laboratories, which is a healthcare pharmaceutical company. Really interested in looking at that. There has been an insulin shortage, and I wanted to see if that's affecting them. It could be a positive thing for them. It could be that they can get a better price and really expand their margins here in the quarter. Morgan Stanley, they announced, I'll take a look at that. Prologis, I believe and I'm kind of guessing a little bit, but I believe they're in logistics for sure. And I can't remember if they're a REIT, a real estate investment trust, or if they're actually a logistics company, but we will soon find out. And then the final stock that I'll look at is US Bancorp. I've been looking at a number of banks, and I do have a good bank comparison that includes US Bancorp. They announced, so we can take a look at what they had to say. And Kiter, good morning. How are you? You want to look at Sweet Greens and how it stands against Kava. Yeah, we can look at that. They're both kind of health alternatives. Like Sweet Greens, like you go in and you get a really nice salad. I've been in a Sweet Greens. I've never been in a Kava, but I understand that their menus around the Mediterranean diet, healthier alternatives. So we can take a look at the two. I know that Sweet Greens has been a public company for a little while, and they never really took off like a Chipotle, but let's take a close look. I'm going to save that toward the end, if you don't mind, or maybe toward the middle. Let me get through a couple of the earnings, and then we'll get into sweet greens and kava. All right, so ASML announced, and what's their stock doing? Their stock's down another 4%. And it is somewhat stunning that the the order book really is dropping off so much. It's so out of step with the rest of the story around semiconductor and AI that it's a real head scratcher. Now, who is ASML for those that maybe are not all that familiar with them? They are the ones that make the big giant machines, and you need those to make semiconductors, especially the most advanced ones that we're accustomed to seeing today. And these machines are sold for millions of dollars, and they have a very long lead time. If you order a machine today, you'll get it in a year. Probably start producing chips in about a year. So it's a very important company to this space, and they are a very dominant company. They're pretty much like the monopoly for these machines. They're out of the Netherlands, and they are a very good market cap company, 286 billion. Obviously, they're 16, 17% less uh, from yesterday to today, and then another close to 5%. So they've really lost a lot of market cap. Let's take a look at their stock chart, just looking at the 30-day. Geez. So looking from yesterday to now, they've lost 20% of their market cap. That's huge because 20% on their market cap, that's above $60 billion in market cap lost in what is, less than 48 hours. So that's really substantial for a company to come out with such negative news, knowing that that's going to really cause a big loss of market cap. It's really going to affect investors. It's really, really concerning, I am sure, to ASML stockholders and also semiconductor investors. I've been investing in semiconductors for a long time. I've been an investor in and out of Intel for 20 years. I've been Broadcom investor. I've been an AMD investor. I've been an NVIDIA investor. Right now, I own Qualcomm. That's the one that I think is worth owning. But in general, I've made good money on semiconductor. Semiconductor is cyclical. It goes up for a couple years, down for a couple years. And each company, it seems, they make their semiconductors for particular use cases, purposes, devices. And these devices last a long time. Just look at your iPhone or your Android device. You don't replace that thing every month. It's not like Netflix that you have to repay that subscription every month and Netflix gets a reoccurring revenue. Now you buy a device and maybe you own it for 5 years. Heck, maybe you own it for 10 years. And so when a new technology, a new innovation is introduced, it really does drive more unit sales, but then it fades once everybody has, or a substantial percentage of the market has adopted that technology. Demand fades. And that's one thing that exists in semiconductor. And I think that semiconductor about a year and a half ago started getting priced as if it was not cyclical. And I think that's an error. But we'll see. Maybe it does stop being cyclical. It'd be a giant surprise for me. But the market, like ASML, has surprised me from time to time and has taught me lessons as well. So we'll see how things play out. So ASML is down. Their future revenues are expected to be much lower. And that certainly is a big influence on the semiconductor space. It's only 14 minutes into the trading day. For all we know, this is going to rally to some extent. But so far, the sell-off of ASML continues. If we look at, I think I have Yeah, I have the semiconductor stocks here. Let's take a look at where these stocks are trading. So right now, Nvidia is bouncing back. TSM is bouncing back. Broadcom is in the green. Qualcomm is still in the red. That's the one that I own. So interesting that semiconductor is bouncing back from a red day. We'll see if they keep their gains and what happens. Again, TSM is the stock that is going to announce tomorrow. And when I say tomorrow, I believe they announce before the market opens because they're in Taiwan. So I think Taiwan is already done for their Wednesday. It's already the middle of the night. It might even be the next day, early morning hours in Taiwan. But they will announce, we'll get their data, we'll be able to process it and get a clearer picture or better expectation of what's going to happen in semiconductor. I'm sure everyone's going to be analyzing TSM because their announcement just became 100 times more important and probably 100 times more viewed tomorrow. So that most definitely tomorrow on our live stream, we'll take a look at TSM. And then next week, we'll look at Microsoft. When they announce, I believe Microsoft is announcing on Tuesday. All right. So that is going on with ASML. Man, that sell-off is substantial. And this company, FYI, I've looked at this company in the past, and it was always a little bit tough to get myself to invest in it. Let's take a look at their fundamentals. Now, so this is their most recent quarter ended September 29th. And the revenue growth is there for the quarter. But again, they guided that, hey, their order book, future orders is really down. So they're going to see a lowering of revenues. And you can see the cyclicality, right? When I talk about cyclical nature, you had, a $7.2 billion quarter and then 5.3. And let me go to the annual. So we went up to, so actually this is showing that they've gone up nicely upward, and then they're beginning to really fade. They went from 27.5 billion down to 26.2 in the trailing 12 months. And they're now guiding that, hey, we're probably going to have a tough 2025 and a 2026 because again, their machines, it takes a long time for them to, once they get the order, they'll deliver it like, I don't know, 6 to 12 months later. So they're really guiding toward future revenues. So the revenues look good. You can see that they are the dominant player in this space. Their machines are massive. They look like a bus, literally. Not quite as big as a bus, but you kind of get the picture. And they cost a lot of money. These foundries do not just kind of buy an ASML machine and put it in inventory for spares. No, it's a big investment, and to install it, it also costs money. And then to run it, they have to train their staff and have qualified people that can run this machine. The ASML machines are pretty much hands off to humans. It does pretty much the whole process because the semiconductors, now the circuits are so tiny. You need a microscope to even see them. There's no way humans can do it. All the best that humans can do is build machines. In the case of ASML, they build the machines to create those semiconductors. So the revenues look good. Let's take a look at profitability. Did go down a bit. Free cash flow. This is where I have a hard time with this company. Free cash flow is not great. At 3 billion per year, and their growth is good. But let's say I took 3 billion times 20, I'd get to like 60 billion in value based on those cash flows. Let's say I really like the company, multiplied it times 30, I'd get to 90 billion. Well, this company's valued at 286 billion. So I can't get there through cash flow. It's just not in the cards. When we look at their balance sheet, do they have lots of cash and very little debt? They have very good cash. They have more cash than debt. So they actually have a surplus of cash compared to their debt. That looks good. Analysts have always have liked this company, and 5 analysts covered the stock. They believe it's highly discounted. Wow. I bet they're going to restate their price targets because the stock's really collapsing. And when we look at their future earnings per share, I wonder if this is going to stick. These projections are for really good expansion in 2025, but the company's guiding that, hey, we're not going to have a lot of revenue. So maybe these revenue forecasts are way off. And they need to be restated for them. So yeah, I think these analysts will have to get back to restating these numbers because this doesn't have a 50% drop in the order book implied in them. So we'll see. All right. So that's ASML, the semiconductor space. That's really big news. Okay. So let me go ahead and jump into Sweet Greens and look at Kava. So Sweet Greens, they do a very healthy menu. And let me take a look at something really quick. Just kind of look at the stock charts. So Sweet Green, compare it to Kava. Kava's really been appreciating quickly. I believe both of them are small caps. They've actually been following each other. That's pretty cool. Both Sweet Green and Kava have been doing really well over the past year. Over the past 5 years, Sweet Green, they IPO'd, they went down. This chart is kind of unusual because Kava just went public, looks like in 2023. So they've been public for about a year. So we'll keep the 1 year. That looks really darn good, right? Sweet Green is up 227, 287 on the Kava side. And these companies predominantly get valued that way based on their growth. Now, I voluntarily say I don't like restaurants. I don't like that industry. I think it's too difficult, too much competition. You have perishable ingredients. People can get sick on your food. I mean, just problem after problem after problem. You have to hire a bunch of people and you have to pay them. You have laws, administrating a business with a lot of employees is tougher. So all those things basically lead me to say, I'd rather not invest in restaurants. But for those that like restaurants, let me go through and take a look at Sweet Green. Sweet Green is growing nicely. They are somewhat of a small company. This, I believe, is in millions. And they've grown really nicely. 24.75% is excellent growth. Let's look at the gross profit. Gross profit is not great, right? There's $650 million of revenue and about 127 million ends up being gross profit. That's like gross profit, and then you have to administer your business. So it's not a lot of profit. In fact, they have an operating loss, and they've had an operating loss for their whole the last call it 4.5 years. So that's not good. Cash flow, they are negative in cash flow, but are close to becoming positive. It's still a negative cash flow over the trailing 12 months. So this is why I have a hard time valuing this company. A couple of things that I don't like is obviously the cash flow is not positive, but I don't like these margins. And what happens to Sweet Green if in 2 years, some other company that knows how to make salads a different way that people love, there's a new lettuce that people are just fell in love with, and this other restaurant, really serves it up. And this new lettuce really makes you feel great. Sweet Green is going to have to adjust. They're going to have to hopefully get on that new trend and get customers to come to their restaurant. I know that Sweetgreen probably has pretty good loyalty. People that go to Sweetgreen are looking for a healthy meal. I've eaten at a Sweetgreen. From what I recall, it's not cheap. It's not like Chipotle, where you go in and boom, you're good out the door with, I don't know, a $12 burrito or so, or give or take. I went to Chipotle yesterday, so I can kind of price check it. It was about $12 for a burrito with chicken. And I think if I recall, Sweetgreen was more like $20. Not a total, red flag. I would just say as you go up in price, you're losing people that don't have that discretionary income and would rather go to a less expensive restaurant. All right. So Sweetgreen, their revenue growth looks good. I don't like their gross profit. It's pretty narrow and they're not generating free cash flow. On the balance sheet side, let's take a look at how much cash and debt they have, which could be a problem for a company, a big one. And they have a good amount of cash and they have $310 million of debt. So not too bad. They have $66 million of net debt and they do EBITDA of 40 million. So their balance sheet's okay. They just got to stop burning cash, which I believe they're going to stop doing. Looked like their free cash flow was on its way to being cash positive at some point. So the company is on its way to being cash positive, will eventually be on its way to being profitable, I would hope. It's just harder to become profitable when your margins are so low. You saw the margins, they're not exciting. They're compared to technology or healthcare, other industries, they're terrible. That kind of margin is just not good, but it's the restaurant business. So we have 13 analysts covering Sweetgreens, and in general, they think the price is a little too expensive by 6% on average. There is an analyst that's like, this company is not worth $36 a share. It's worth $13 a share. And one says, hey, it's actually worth more, $45 a share. This is all based on earnings per share. And the earnings per share, I don't even know where they're getting their price targets because it's negative. How do you get intrinsic value from negative numbers, right? So this is all really projections on their part. At some point in the future, Sweetgreen will be profitable. At some point, they'll be cash positive. At some point, they'll be worth around this amount of money. They're a $4 billion company. So it's easy for them to, or I should say, a small cap stock, it's easy for them to go up 50% in appreciation because the market cap move is not that substantial compared to, let's say, an NVIDIA that's at like 3.3 or so trillion. So when they go up 10%, that's like 330 billion of market cap. It's a huge influence on the market. So Sweetgreen's a small cap. It's seen a fabulous year. I mean, look at that year. Congratulations to whoever is in Sweetgreen. It was probably a story of the company was so sold off. You see how they IPO'd, and boy, they were really received with a high stock price. But from there to their low point, they really sold off. Let me try to grab that. They sold off like close to 88% from their IPO price down to their low, which was established like in 2023. And, really up until 2024, from their IPO being in 2021, I mean, investors were really hurting. But then, the stock started to move. And within this year is when the stock really moved. And I think it's a story of the stock was so beaten down that it couldn't go down any further. And it did go up. Now it's at $36 a share. These stories will repeat themselves. The market will sell off a stock. It's implied that that business is not going to exist in the future. It's going to go out of business. It's going to go away. Well, when they prove that they're not, that they're here to stay, they have a line of sight to, being cash positive, to, turning a profit at some point, investors start to pile back in. So that's been the story on Sweetgreen. It's not an investment for me. I'm just kind of sharing my observation on it. Now let's take a look at Kava and see how Kava stacks up against Sweetgreen. So Kava's got a different menu. They've also been just growing really well. It's a $15 billion market cap company. So it's almost 4 times bigger from a market cap perspective than Sweetgreen. And the revenue is 845. Sweetgreen revenue is 650. So they're somewhat close in size from a revenue standpoint. They do have net income, so they're already profitable, which is very good. Slightly profitable, but they are profitable. PE is massive, 351. Whew. And then analysts like the stock. It's a buy, but you're paying a premium of 14%, which doesn't make any sense, but we'll take a closer look. So let's look at Kava. Their growth rate's been really good, 30%, $845 million in revenue. Their gross profit is better than, it seems to be better than Sweetgreen's, but it's still not very good. If you look at this percentage, you're looking at gross margin, you're looking at less than 40%, probably around 35% gross margins. It's not very good, because then you have to pay your staff to administer the business, operating expenses, and so forth. So you end up with a very small profit margin. You're making 4% operating income on that revenue. That is terrible. After all that effort, you make 4%. And free cash flow, they are producing a free cash flow rate of $11 million. And I'm sure that the projection is for it to grow, but it's not going to grow very fast and very high because of the gross profit being a restaurant. You just don't have a lot of profit to work with, and for that profit to end up being free cash flow. So Kava is, both these stocks obviously have worked and they've rewarded investors. But it's just, where's it going to go from here? I would say that, if I was going to guess, I would say that there's a greater chance that this stock is going to go down in price and down in value as opposed to going up. If they just finished a 300% return, you really appreciate it nicely and have baked in a lot of good news. It doesn't take much for the stock to really sell off, because investors, as quickly as they became really interested in Kava, they could very quickly get out of it. It's not like a McDonald's in their space, which has been there forever. Very large, predictable, established, dividend, all kinds of good stuff, showing growth. This is a new company, a new concept. And it's not a Chipotle. Chipotle has a very good track record. So I'm not into restaurants by choice. Both Kava and Sweetgreens have had phenomenal years. It's your investment, however you want to handle it. But those are my observations. It's both of these companies are priced with a lot of positive news in the future to come. They're priced as if they're going to continue to grow, and they will at some point be profitable. Probably investors are using Chipotle as the map to this stock. Like, hey, if these guys could become the next Chipotle, then we would really make a lot of money. And Chipotle has been a very good company for investors. I owned Chipotle a while back. This has a market cap of $81 billion. Very good market cap. Company over 5 years has done very well, 257%. Most recently, they lost their CEO. I looked at the stock to see, is it just a ridiculous discount? Am I willing to go into Chipotle? One of the things that happened when I was a stockholder was Chipotle had some nasty, some viruses that are, um, ended up in the lettuce, and people got sick. And when those events happen, the stock really tumbled. And it's just part of their business, right? They serve food to people, and in some cases, it's a raw ingredient like lettuce. So they had a lot of trouble with that, and that's the restaurant business for you. I think Chipotle is a really well run company. I like the simplicity of their menu. I like their food. Um, I think it's a good value for a quality meal that I think is relatively healthy. And the company is priced at a premium, 57 PE, excuse me, 58 PE ratio, forward P of 50. Now, a company that has a PE like that better be growing. And when we look at this growth rate, I can get better PEs in technology with a better growth rate. And technology has far better margins, far better cash flow. So restaurants are not for me. um, but Chipotle has been a quality company. I think that Sweet Greens and Kava are using Chipotle as kind of like the model of, hey, if we can be like Chipotle, we'll have a market cap of 50 billion at some point. And investors are probably using that as an expectation as well. So, Mike, the dividend investor guy, good to see you this morning. How are you? So, um, and Kiter, that's my review of Sweet Greens and Kava. I hope you found my comments interesting, and good luck with it. Good luck with your analysis there. So, Mike, if it's a rotation into small caps, then it would be a blessing to me. You're heavy into small caps. I have a fair amount of small caps as well, but I would say that I'm also in big caps. Let's take a look at where the market is trading. You are right that the Russell is doing quite nicely today. Now, the one thing I would say about the Russell is it kind of has it's shown us a couple good days, maybe a couple good weeks over the last, I don't know, 2 years. But they just got to sustain their darn rallies, man. If you look at the 1 year, it's doing quite well. I'm kind of taken back by how good that looks. But let's compare that to the S&P. The S&P is outperforming it, but frankly, I'm impressed with the Russell. The Russell's many more companies. Once we get to the 5 year, you can see the separations there between the S&P and the Russell. So maybe I stand corrected to some extent that it is showing some resiliency, and it is showing that, hey, the small caps are going to start performing. At some points like here earlier 2024, you could see that it was underperforming the S&P, and then it had a really nice rally. Then it came back down along with the S&P. We had a sell off in August, and it's been doing quite nicely. I think companies like we just saw Kava and Sweet Green, which are both small caps, they're doing really well. But there's lots of companies that are small caps that are doing well. In general, small caps do have better fundamentals of those big, massive caps. I do acknowledge that. It's just the comfort level for investors to go into them hasn't been there, but maybe it just has begun to get very comfortable. And you're seeing that rotation from big caps to small caps. I hope it continues. I think it's a healthier market if we get a rotation out of these massive caps into small caps. All right. So we went over Sweet Green. We went over Kava. Now let's take a look at Abbott Labs. So Abbott is up 2%. So they should have announced, and I don't see any news, but based on the stock price, the news is probably positive on Abbott. Let me take a look at their investor page as well. Maybe we can get the earnings announcement there. And this company, I'm familiar with it because I worked with one of their competitors for um, 3, 4 years. So we competed directly against Abbott. So I got to know them from that perspective. Okay, so here's Abbott Labs. Let's get over to their investor page. So sales. So they had sales growth in the quarter of 4.9%. And this is healthcare. These guys in a part of healthcare that's a consumable, very stable business. So 4.9%, I'm going to think is pretty good for them. And I'm going to show their historic growth in a little bit, but that looks pretty good. They're maintaining their full year guidance that they're going to grow close to 10%. That's really good. Okay. So that looks good. So their sales are good. Okay. Very good. So sales were good. These guys are like a factory for a lot of the products that end up in a hospital and that are consumed to treat people, like insulin or other things like nutrition products they provide. They were also doing COVID tests. I think the government did a big contract with them to do COVID tests. So there's their business broken out. Trying to get to their income statement if they provided it on this earnings, and as well as their statement of cash flows. Okay, so here's their income statement, and this is for the quarter. Okay. Cost of goods sold. So operating earnings, it's almost, it's about 18%. And that's pretty good because that's after gross profit. Like the gross profit would actually be 10.6 minus 4.6, which ends up being about 60% gross profit, which is very good. All right. Net earnings look good, nice and profitable. I believe they pay a nice dividend, which I'll review in a bit. So the quarter was good. They're expecting to have about 10% growth this year. And when we look at hopefully they show us a statement of cash flows. They really break out their sales every way you can imagine. I'm not sure that I don't need that kind of level of detail, but maybe other investors do. So the quarter looks good. So Abbott had a good quarter. This is a significant cap company, $206 billion, $40 billion revenue. Look at the stock. It's worked somewhat. You get paid a dividend less than 2%. So it's not a really high dividend. For the 1 year, it's up 30%. So it's been good. Healthcare really did not work in 2023 from my observation. And I'm an investor in healthcare. So I'm like, healthcare didn't work in 2023, but it's really beginning to work this year. It looks pretty good for Abbott. 30% increase in its stock price. Then you get that 2% kicker in the dividends. So that's a very good return out of a healthcare company that is very stable, very reliable, very established business. This business has been around for a long time and it will continue to have very good demand. Just doing a quick valuation. We'll start with the forecast first on this one. They have 12 analysts that are stating their price targets here. And one analyst is optimistic at 143, the lowest 107. The disparity is not very broad. It's somewhat in the same area of price targets. It is discounted to some extent based on their projections and their price targets. And it looks like they're going to expand their profitability. So this looks pretty good. Earnings per share look good. Maybe they can increase their dividend. That would be a good thing. So we know earnings per share will get us to the valuation, but let's take a look at free cash flow because that's really my desired way of valuing companies. And their free cash flow, very good cash flow producing company, but it's not going to get me there. I'm probably going to get to like 120 billion in value for the company based on free cash flow. And the company's priced well above that. So I could find better valuations in their industry. So I think it's a quality company, very well liked. Investors in it will stay in it, but it's just a little too expensive for my liking. I think I have other alternatives that I think I'm going to do better with than Abbott Labs. They're having a good day, up 2.46% at this moment. It looks like they really are operating their business well. So Abbott Labs making it happen for healthcare. Let me take a quick peek and see what here are the different sectors, and let's see where the sectors are ranking today. So right now, the number one sector is financials, industrials second, real estate is third, utilities fourth, materials, energy, healthcare is here in the green, but not leading the pack. And technology is lagging. So that's interesting. And then communication services is lagging. Okay, so based on sectors, I mean, that's a pretty good balanced, gains. What's the market overall doing? Is it up? So the S&P, so the Dow is up. So those 30 companies that make up the Dow, these are very well known, big companies, up 0.32, S&P is up 11. Now it's 0.095. And then NASDAQ's down slightly, but the Russell's where all the action is today. All right, good. Very good. Okay, so Abbott, quality company, a little bit too expensive for my liking. Morgan Stanley, look at that, up almost 7%. They had a really nice earnings. These guys are a big wealth management financial services company. They help clients make the right investments and really have management fees on their investments. So these guys do well and the market does well. Guess what? The market's been doing great for 2 years. So guess what? They're up nicely. They get more fees when their clients are investing more money. So it's a pretty interesting business. It's pretty simple business once you break it down. These guys are big wealth managers. There's a lot of trading volume going through their business, and they're growing nicely with good profits. So this is working. And this is kind of an old school company. I think I dislike old school because I think these are businesses that will continue to get more disrupted, and they'll continue to get more lose customer bases. And companies like Robinhood and new generation companies that help individuals like myself self-administer my wealth, that will continue to grow. It's my expectation. I can tell you that I have hired wealth advisors, and my experience was not positive, but I'm probably the wrong client for them. I didn't use Morgan Stanley, by the way. They want you to kind of sit in the back seat. They're going to handle everything. And of course, they're going to charge you for everything. And they don't commit to a rate of return. They'll just cite that, hey, we're really good and we'll get you a market rate of return, which will really be less than market, because once you look at their performance, they're probably not going to outperform the S&P, and they're probably going to charge you fees. Now, the piece that continues to expand is in this new world we're in, where access to information has never been better. It's the golden age of investing. We can get information, like I'm showing you information on companies quite easily. And 20, 30 years ago, that was not the case. So old school 40 years ago was totally valuable. You needed people that really understood, can do the homework and literally break open books to study companies. Like when Warren Buffett first started investing, there was a book published on companies with their financials, a book once a year. So you'd go through this book and go, oh, this company's good. And it was updated once a year. That's the information they had in that day. Now, like ASML announced yesterday, boom, we had the information. Within minutes, the stock reacted. Within minutes, investors had information. So the whole value of a Morgan Stanley in the future, I believe it's going to be harder and harder for Morgan Stanley to operate with their traditional, kind of business models. And I think newer companies will continue to take a greater amount of market share, and or some services will go away. Example is, you know, uh, we have a loved one that is fairly old and needed to update their will and living trust. Within minutes, we already had 2, 3 different really good examples. We're going to help that loved one. So that just eliminated an attorney out of the process. When I first got a will done, like when my son was born, which was 24 years ago, I hired an attorney, and I forgot how much I paid that attorney, maybe $500 or $1,000 24 years ago. So today, I don't know, that'd be $1,000, $2,000 of attorney's fees for a simple will. Well, fast forward, the will date they wrote me was not that complicated. And today you can just get a template and eliminate the attorney fee. That's an example of where Morgan Stanley has had traditional services that were of great value, but now it's like, wait, I could get that on a good website. I can watch a couple of good YouTubers, follow people that I think I can learn from and become a really good investor. So Morgan Stanley, I think in the future is going to struggle. That's why I don't invest in Morgan Stanley. I'd rather invest in Robinhood and other companies that I think are going to do better over the long haul. This company's done well for the last year. So congratulations to investors that have invested in Morgan Stanley. And I'm glad they're having a good day. All right. So I'm not going to be able to get to all the companies that I wanted to, but I'm going to end with US Bank after I say hello to a few people. And I'm going to start with Bobby. How are you? Good to see you, man. 2 days in a row. Awesome, man. Good to see you. And then Enkiter. Yeah, thanks for bringing it up, Enkiter. DLG. Let's take a look at DLG. I don't know that I've ever seen. So DLG, direct line insurance. So okay, so I like insurance companies. So let me start by saying that. And Shadow Guy, I'm gonna get to your question. And in just 1 minute. Okay, so all right, so so I'm in Allstate. That's been good. The really awesome investment in the US has been Progressive. They've done great. And insurance is one of those businesses that usually Warren Buffett gives you a pretty good clue of what is a good business to own. And he's owned Geico for a long time. I think they own Geico all out. So, and the reason for it is that it's a very lucrative business. Let's see what Direct Line Insurance Group is all about. So Direct Line Insurance engages in the provision of general insurance products and services in the United Kingdom. So it seems like these guys sell the insurance. They will write insurance policies for you, but they're not the insurer. Let me confirm that by going to their website. And that's a big difference, by the way. That would mean a substantial difference to me in my mind. And I'll explain why in a minute. So the big question for you, Bobby, is do these guys underwrite the insurance policy? Meaning, is the premium paid on an insurance policy going to Direct Line? And are they taking that money and then able to invest it, work with it, and so forth? And if the answer is yes, then they're a full blown insurance company in my book. If they're just kind of a seller of insurance, like, for example, a car, there's the manufacturer of the car, and then there's the auto dealer. The dealership's making money on the car, but whoever makes the car is making that, the profit on the manufacturing process and so forth. Insurance, it's very lucrative to be the insurance company that underwrote the policy. Just to use a simple example, receives $1,000 from a person or a family to insure, let's say, their home. And if no claim is made, you keep that $1,000. Of course, you got to have all that money in reserves because you have to be able to pay for claims, and not everybody's going to make a claim. So you have actuarians that do the math and say, okay, we're going to pay this number of claims. We're still going to have this type of rate of return and margin and so forth. But what becomes lucrative is the insurance companies get to invest those funds in good, safe investments while they have those funds in hand. So that adds to their margins and it becomes quite lucrative for them. So having said that, that'd be the first, homework item. I'd say Direct Line, you got to figure out, are they truly an insurance company that wrote the policy, or are they just selling it? I'm going to run on the assumption that they're an insurance company and just kind of spell out what I'm seeing based on that expectation. So the market cap is 2.36, and this is British pounds, I believe. And the revenue is 3.38. And I'm beginning to think that they're more of a reseller of insurance, because if you look at other insurance companies like Allstate or Progressive, they're valued much higher. They have a PE of 7.9, 11 is a forward PE, dividend of 2.2. Their revenue is growing, but they had some tough years in 22, 21, 20, and 19. But they are growing nicely. Now, some of these years here in the United States, the rates on insurance were just not high enough. And in the United States, it's a regulated industry, so they have to work with state governments to increase the policy rates, and then it gets approved, and then they're able to charge higher rates. They've gone through that cycle with states and are now making good profits. So I would check out the company to make sure that they're actually an insurance company. Now I'm beginning to think these guys are just a reseller. And right now they have negative cash, which is bad. Why are they having negative cash flow? So they sold some assets. Or actually, there was a gain on a sale of an asset that is reversed because that was a non-cash item. So that's why a lot of the negative cash happened. So they are making positive cash, because this is, to me, that's a non-operating item, and that's not going to happen every year. It's just going to happen once in a while. You can see it only happened once. So they're more of a 400 to 800 million dollar or million British pound free cash flow producing company. So you're going to get this company to value above 2.36 based on cash flow. If you multiply it times 10, you get to like 4 billion. But the big question that I would have is, are they an insurance company or just a reseller of insurance? And right now I'm thinking they're just a reseller. I couldn't make out, based on their website, if they're actually um, uh, behind the policies, and you'd have to go through their quarterly in detail, understand it, and then be able to make that determination. Are these guys just reselling the insurance? And yep, they make a nice little margin, but it's not as lucrative as an insurance company. But the fundamentals look okay. The stock hasn't been working. I think that they probably had that asset sale. Is that going to affect their revenue? That'd be a question that I would have. I think insurance really worked for the last 12 months. I think it's going to continue to work. And the other thing that insurance companies were able to do with higher interest rates was they were making more money on the money they were all the premiums they were receiving. They're able to invest them at a higher rate. With higher interest rates, they were making more money. So those are the comments I have there. I think it's a good idea to look into insurance. Really good companies there, good money to be made. All right, so Shadow Guy, macro question. Yeah, when recessions hit, small caps tend to sell off because as people get scared, they want to go to names they are very familiar with. McDonald's, Home Depot, Walmart, these big names, Microsoft. The bigger names tend to hold their value better. So that is a logical expectation. So if Bobby, if Direct Line underwrites the insurance, that looks like a really interesting stock. I think that insurance has seen a time when, and you got to make sure that you also feel comfortable that they know how to underwrite their insurance, because premiums are really going up and the profitability is there for the insurance companies. The actuarians and the mathematicians make sure of that. So this looks really good. If they're the underwriter, the cash flow looks good. They had a bump along the way because they had this asset sale, but asset sales are not going to happen ordinarily. They're only going to happen once in a while. Reinsurance recoverable. They had this event. So they've had some events there that you got to investigate, make sure you understand them, understand that they're only going to happen once. They're not like, it's not because the business is broken or that they're kind of handicapped because of these events. So that would be homework item. But I think you're onto a stock that could be underappreciated and can have potentially a really nice path forward, because over the last 5 years, it's sold off. When you look at other insurance companies, they had a similar situation. I'm going to look at Allstate because I'm in Allstate. If you look at the 5-year, they had, they were selling off here because insurance rates were not high enough, and they have to work with, state governments and stuff to get their rates higher. But once they got their business organized, come join the party. Really nice appreciation rate. So you may be dealing with a stock that is kind of going through this phase of getting things organized, and hopefully are beginning a phase like this where it really appreciates nicely. So I think you're on to something that is interesting. Take a look at it, analyze it, come back. Let's talk about it again. Good luck with it. Good luck with your analysis on that company. So thanks for bringing that one up. All right, everyone. So I've got to run. I didn't get through the whole list, but we got through a couple of good companies. And let me take a peek at the market again and see that, hey, now we're all in the green. All right. Looks good. Nice day to recover from a bad day yesterday. It's like, man, you stayed up too late, had too much of a good time, and you're kind of like, oh, come on. And it's like, all right, cool. Catching a break. And let's take a look at the sectors. Materials, industrials. All right. Financials, real estate. Looks good. Technology is not showing a number, which is kind of weird, but looks like we're in the green. Let's see if we can hold it. Kind of just have a mellow day. and see what happens. So, all right, everyone. So that is the live stream for the morning. I'm going to be back this afternoon, evening at 5:30 Eastern, and I'll cover the stocks that are going to announce after the bell closes or the bell sounds, and I'll also cover a couple other stocks. Probably a stream about the same length or maybe a little shorter than this one. If you want to join, that'd be great. I'll also be back tomorrow. Let me show you my schedule. I think some people have asked questions around the schedule. So let me put that up. And Monday through Friday, you just attended the stream, from 9:30 to 10:30 Eastern, Tuesday, Wednesday, Thursday evening. And then we have, we have the community. If you're a community member, we have two meetings on the weekends. The Saturday meeting is going to be for a workshop to get into evaluations, really look at financials, and it's going to be more of a workshop setting where members can actually share their screen and we can kind of go through it. And hopefully it'll be a really good learning exercise for the members in attendance. If you'd like to attend that, become an advanced member and you would qualify to attend that. And then on Sunday, again, we'll have a member conference call on stocks, topics around stocks. It should be a good meeting because there's so much going on. I'm sure there'll be really good discussion on Sunday. And again, if you'd like to attend that, become an advanced investor and you will be invited. So take a look at the details if you're interested in the details of the live stream, and you can get signed up. So that is it, everyone. I really appreciate everybody attending. Good luck. Good luck investing today. Let's see how the market behaves and see what additional news we get out of these earnings that we're seeing over the next couple of days. Take care, everyone. We'll see you.